Cryptocurrency, emergence of non-bank loan products. Your question.
I am the bank's CFO who wrote you last year about my concerns regarding the fungibility of cryptocurrency, like that of the dollar. I was concerned and skeptical. Your response was helpful. I distributed it to our board. Since then, I joined a non-bank as CFO. It is a large wholesale lender that has developed cryptocurrency loans. We literally use crypto to create new loan products. Non-banks have much greater flexibility in cryptocurrency for product development. I have been astonished by the product rollout process and by how particularly high net worth and crypto-native borrowers are drawn to using cryptocurrency. I wonder how extensive this trend is spreading in the non-bank mortgage market. What do you think non-banks will do to develop cryptocurrency loan products in 2026?
Our compliance solution. We suggest AI Policy Program for Mortgage Banking. Our AI Policy Program aligns with Freddie Mac's AI governance requirements for Freddie Mac sellers and servicers. Responsible AI practices can help align AI system design, development, and use with applicable legal and regulatory guidelines. Our AI Policy Program consists of the following policies. 1. Artificial Intelligence Governance Policy. 2. Artificial Intelligence Use Policy. 3. Artificial Intelligence Workplace Policy. 4. Artificial Intelligence Credit Underwriting Policy. 5. Artificial Intelligence Do and Do Not Policy. 6. Artificial Intelligence Ethics Policy. 7. Artificial Intelligence Vendor Management Policy. 8. Artificial Intelligence Mortgage Fraud Policy. Contact us for the presentation and pricing. Response.
You asked a thoughtful question last year. Your main concern was that cryptocurrency had the same fungibility as the dollar. Indeed, your specific question was, should cryptocurrency be accepted in lieu of dollars for a down payment on mortgages? Non-banks are using cryptocurrency innovations to gain market share from traditional banks, which remain more constrained by federal safety and soundness regulations regarding crypto exposure. Coming from banking to the non-bank world, you will surely find a strong interest in developing more ways to offer new residential loan products. Cryptocurrency continues to grow in popularity. Non-bank mortgage lenders are the primary drivers of cryptocurrency integration in the mortgage market as of 2026. Because they operate with more regulatory flexibility than traditional commercial banks, non-banks are using crypto to create new loan products, streamline underwriting for digital asset holders, and leverage blockchain to lower operational costs. I noted that you referred to two types of cryptocurrency borrowers: high net worth and crypto native. I'm sure most of us know what high net worth means. AI has a significant role. Without AI-driven underwriting, risk modeling, and document automation, crypto mortgages would remain a niche product for wealthy borrowers. I discuss AI below. Many may not know what a crypto-native borrower is. A cryptocurrency investor with the knowledge to use crypto financial instruments independently. That is a widely used definition, but in my opinion, it is too broad and a bit misleading because millions of people in the crypto market should stick to the dollar. Perhaps I will discuss this type of borrower in a future article. Cryptocurrency is fundamentally changing mortgage banking in 2026 by shifting from a speculative niche into a recognized asset class for loan qualification and collateral. Key shifts include Fannie Mae's historic decision to accept crypto-backed mortgages and the mainstream integration of digital assets into standard underwriting processes. Mainstreaming integration and new mortgage products. Major financial players have introduced products that treat cryptocurrency as a legitimate financial asset rather than a liability or a black box. For instance, Fannie Mae approved crypto mortgages launched on March 26, 2026, with Fannie purchasing loans in which Bitcoin or USD coin, USDC, was used as down payment collateral. There is continued acceptance of crypto as an asset class. The recognition takes the form of lenders accepting Bitcoin and Ethereum for mortgage qualification without requiring liquidation, allowing borrowers to maintain their investment positions. Indeed, some lenders now allow up to 25% of Bitcoin held on exchanges like Coinbase, or up to 50% of crypto ETFs to count toward loan reserves. Indeed, there is the development of a two-part loan structure You might call it a dual loan structure, where a second loan backed by crypto funds the down payment, which is then integrated into a single monthly mortgage payment. In other words, this structure involves a traditional mortgage and a crypto-backed loan. Therefore, unlike traditional banks, which often require a 2-month seasoning period for a bank account, lenders treat crypto as a qualifying asset, similar to stocks or bonds. Thus, borrowers receive 2 loans at closing, a standard Fannie Mae mortgage on the home and a second loan to fund the cash down payment, secured by pledged crypto. Both loans share the same interest rate and amortization term, resulting in one combined monthly payment. The mainstreaming of this dual loan structure began when Fannie accepted its first crypto-backed mortgage in partnership with Better Home and Finance and Coinbase Global. In effect, this partnership created the first token-backed conforming loans that meet Fannie's standards. The loan was structured so that the borrowers pledged assets such as Bitcoin or stablecoins as collateral for a separate loan used to fund a down payment, allowing them to retain crypto exposure rather than liquidate their holdings. Both loans are held by Better Home and Finance, with pledged crypto locked until repayment. Underwriting standards. Our non-bank clients involved in crypto are recognizing the need for standards to assess the risks associated with high-volatility digital assets. Collateralization ratios are being revised to mitigate risk. Lenders typically require high collateralization. I have seen some loan programs that require $2.50 in crypto for every $1 in down payment credit. The risky margin call dilemma has been addressed by new programs from Better Home and Finance and Coinbase that remove traditional margin calls. Market declines alone don't trigger an immediate liquidation unless the borrower becomes 60 days delinquent. Importantly, Bitcoin price volatility has no impact on the mortgage or the down payment loan, meaning there is no top-up requirement. Even if Bitcoin drops significantly, borrowers are never asked to add more collateral. Liquidation is only triggered by a 60-day payment delinquency, just like a conventional mortgage. I am somewhat concerned about the revision to documentation requirements because crypto underwriting is accepting exchange statements from verified platforms as valid proof of funds, whereas previous standards often required a 2-month seasoning period in a traditional bank account. However, some lenders are allowing borrowers to include verified cryptocurrency as part of their income and asset qualifications under non-QM lending standards without liquidating their digital assets. These products only work because AI can analyze blockchain transaction histories and crypto portfolio data alongside traditional credit signals. In fact, documentation can be automated by integrations with crypto exchange APIs, such as Coinbase Prime, allowing non-banks to verify assets in real time and reduce manual documentation. AI is revolutionizing underwriting for crypto asset borrowers. Crypto holders are often non-traditional borrowers. Their wealth may not appear on pay stubs or W-2s. AI is specifically solving this. AI-driven underwriting models now analyze 10,000 plus data points, including alternative data like utility payments, rental history, and cash flow patterns. Mortgage lenders using AI-driven models have reported a 90% increase in processing speed, a process that took 45 to 60 days from application to closing just a few years ago, now takes 15 to 25 days at institutions with mature AI pipelines. Speed and flexibility are critical for underwriting borrowers whose wealth is tied to volatile digital assets. In this article, you will find the table we recently developed outlining the differences between traditional and cryptocurrency mortgages. I hope you find it helpful. A brief word about the tax-efficient impact in the table. These loan products enable borrowers to use crypto as collateral for a down payment, effectively bypassing the capital gains taxes that would be triggered if they sold the assets to fund a traditional cash down payment. However, our clients caution their borrowers to consult their financial advisors for tax advice. Artificial intelligence. AI significantly impacts cryptocurrency transactions. The fact is, AI is the engine power behind crypto mortgage products. I mentioned Fannie's acceptance of the first crypto-backed mortgage structure in partnership with Better Home and Finance and Coinbase Global. Consider this. AI is performing risk assessment, pricing, and underwriting to make crypto collateral viable within Fannie's conforming loan framework. Agentic AI is the defining lending technology shift of 2026. As I've discussed in previous articles on AI, where first-generation AI lending systems required human handoffs between workflow steps, agentic frameworks deploy AI agents that autonomously plan and execute multi-step tasks, retrieving documents, querying data sources, running models, resolving exceptions, and generating underwriting memos, all without human instruction at each step. For crypto-backed mortgages specifically, this means AI agents that can continuously monitor the value of pledged digital assets and flag changes in real time. In our AI policy program for mortgage banking, we provide the artificial intelligence in mortgage fraud policy because AI has become a central feature in reducing both traditional and digital mortgage fraud. Generative AI can reduce the need for manual data entry by automating underwriting documentation, and back-office operations can be automated for regulatory compliance checks, loan file completeness reviews, and certifications. In the crypto context, this is especially important because AI systems can verify blockchain wallet histories, flag suspicious transactions, and detect synthetic identity fraud, which is increasingly common in digital asset lending. Genius Act. Finally, there's the broad regulatory backdrop shaping the funding environment for non-bank mortgage lenders. The Genius Act, which I have discussed in several articles. The Act, signed into law in July 2025, requires stablecoin issuers to maintain reserves backing outstanding stablecoins on a one-to-one basis and prohibits stablecoin issuers from offering any form of interest or yield to stablecoin holders. The debate now centers on the proposed Clarity Act, which would go further. Critics of current policy argue that more widespread migration of deposits into stablecoins, especially if stablecoin issuers are permitted to offer rewards on balances, would result in a loss of low-cost core deposits that support lending to small businesses and rural communities and could dampen mortgage lending offered by banks. The Genius Act's full effective date is the earlier of 120 days after the OCC issues its final rules, or January 18, 2027. So implementation is still unfolding.
This article, Cryptocurrency, Emergence of Nonbank Loan Products, published on May 12, 2026, is authored by Jonathan Fox, Ph.D. MBA, the chairman and managing director of Lenders Compliance Group, founded in 2006, the first and only full-service mortgage risk management firm in the United States, specializing exclusively in residential mortgage compliance.